This week, Learning Saturday, we are conducting two interesting webinars. The first one is Common Mistakes in Fixed Income Investing at 10 a.m. Also at 11 a.m. we have another webinar, the 1 crore journey, only for those serious about 1 crore. To join the two webinars, the link will be in the description. You can join using that.
Making choices in mutual funds. That's the topic I'm going to talk to you today. Firstly, where is everyone investing their savings in mutual funds now? The answer is not very difficult. Data is out. Mostly money is going into small cap funds or some small part of it into mid cap funds. As far as large cap funds are concerned, money is going out. Now, the more this trend sustains, the more irrational investors become with their money, because when you're putting too much money into a space which cannot absorb that much capital, valuations tend to rise. When valuations tend to rise, returns optically look higher. When returns optically look higher, more money chases the same themes. This has been happening in the small cap space for the last 6 months, and it's happening at a higher pace month after month. Now, what can happen? Because most of the people think that nothing can go wrong. If something can actually go wrong, that would be temporary. Valuations are a function of factors beyond liquidity. If retail investor continuously pumps money into small caps, it's also an opportunity on the other side for the promoters of the small cap companies to sell their shares. We are seeing that happen in several companies. It's also an opportunity for venture capitalists to sell out of their small cap companies. It's an opportunity to do private placement QIP in several companies. Who is giving money for all this? Who is funding all these issues? Who is on the buy side? It's the small cap retail investor. It's the retail mutual fund investor. What can happen? Suppose at some point in time, market confidence snaps. Suppose there is an event. After the event, investors are going to definitely pause investment for a brief while if they are shaken up. If the fears rise, this can happen. That's our experience in the past. When that happens, what I see as a big risk is that several large investors may pull out their investments which they have made directly into these stocks in the small cap space. If that happens, if opportunistic capital exits small cap, then the mutual funds will suddenly see their returns run down. What looked as high returns will suddenly start going down very rapidly. And when returns start going down very rapidly, whatever capital that has gone into mutual funds in an opportunistic way will also run out. This is not a healthy thing, but it is bound to happen in every cycle. And when capital starts running out, it starts a negative virtuous cycle. Promoters who want to raise money will become more anxious. Institutional investors who want to exit the stock will sell the stock by allowing the price to go down. All this will create that negative virtual spiral. You saw a positive virtuous spiral over these 6 months. You could see a negative virtuous spiral also happen. When that spiral happens, that will set the stage for a long sideward market in that space. Contrast that phase to what happened between 2018 January and 2020 March. This space was not seeing much of traction. Money was not coming in at a high pace. Money was continuously moving out. Valuations were softening. Sentiment was weak. COVID changed this. The liquidity changes. And the windfall profits which businesses experienced as a consequence of the disruption of COVID changed this. We are seeing things reverse in several sectors, and we are seeing a lot of capital allocation that has happened in small businesses beyond what the business can take in. You've seen big capex, more than necessary investments, and all these things have happened in the very spaces where you saw superb returns 3-year period. This all means that there is going to be a long wait. I don't know whether the investors who are investing in small cap mutual funds or directly in small caps have the mental tenacity to wait that long. And while many of you may have the tenacity to wait that long, your investment performance is going to be driven by investors who don't have that staying power or the tenacity, as a consequence of which the weaker investor who sells will hurt the smaller investor who stays. This is the setting that we are now walking into. As we walk into that setting, it's important that you decide whether you want to remain in that setting and face the pain, or step back from that setting, take your money to safety and probably invest in a safer space. This is not a choice, this is not an option, but this is something you need to consider more as a necessity. Investors who take on decisions on the basis of necessity and call themselves to act in a timely way generally avoid getting hurt, and investors who fail to do that generally set up to get hurt by the behavior of other investors. This is something that you need to consider, this is something that you need to ponder over, this is something that you need to act upon. I hope you do so in reasonable time. Thank you for watching this video.